there we have our risk reward profile. Now this is using a different the midpoint there, so it's showing me a 7.4% risk, which is very palatable for the next 175 days. And I'm going to look to generate income off of this position to lower that initial at risk and potentially cancel all risk on the position. Well, how might I start doing that? I would say now, okay, what would happen if I sold maybe a November only has monthly 75 call at 115? What if I went ahead and jumped into that position now to create the collar? Even though I'm bullish on the trade, if I sold the call now, well, that would take the max risk to the downside down to 5.7%, but it capped the return at 5.7% with the assumption, and this is a big assumption, that implied volatility remains the same on that longer term put option. Now, I make the comment there of that might be a big assumption. Why might that be a big assumption? Just like we talked about last week with the Intel position. If I go to stock research, yes, we're buying an April put on Tidewater for a low 7.4% risk. The worst case scenario, even if the stock fell to $30 per share, the most we can lose is that 658 or 7.4%. And we sold a call just to look, but here's why. So 11/2 is when the earnings come out. Yes, even the April expiration is going to be inflated. I'm getting a good bang for my buck here, it looks like, on this November call, because November series is going to be most inflated. I mean, it's 10% out of the money and offering $1.50 on a $68 stock. That's pretty decent at an IV range, or a current IV of 55.84, 0.5584. But anytime you're evaluating any type of calendar structure on the Power Options profit and loss chart, remember what it's looking at. Whether you're doing a diagonal calendar call spread, double diagonal, a calendar put spread, what the profit and loss chart here is doing, or the custom spread tool is doing, is it's calculating what the position would be worth if the stock was trading at these prices on the short-term expiration of November. And in order to do that, we have to take the Black-Scholes theoretical value, BS value for short, and we've had some jokes about that over the years, but you have to take one of those theoretical pricing models to evaluate what the April put would be worth if the stock was trading at these prices on November expiration. And one of the factors into that theoretical pricing model is the implied volatility of the option. Now, some brokers, your brokerage account will show you the same thing. You'll see the same exact graph because they're using a theoretical pricing model to calculate the expected value of that longer term put option at the short term expiration date. Now, we're using the exact implied volatility currently of that April 75 put. Some brokers might use the stock volatility, which might give you a higher or lower basis of expected return based on their expectation and based on how skewed it is. Some brokers I know actually use the 1 year out, or the 52-week, or whatever it's called, 250-day stock volatility for their calculations when showing the profit and loss charts. I think that's a little bit too long. I think it's too smooth, and it doesn't give you a great picture of how the options are actually going to react, especially in a volatile market. But we don't want to assume everything rosy between these prices of 66.35, not far from where we are, and 89.68, because we've created an upper and lower break even. I want to make sure of some things. Anytime I'm doing a calendar spread, any type of married put with a short-term collar, and I see these kind of implied volatilities and I know earnings coming up soon, I want to investigate further. I don't need to worry about the 75 call. I'm selling that at this inflated implied volatility right now, and I'm going to get that premium or close to it. If this implied volatility drops after November 2nd and the stock doesn't move too much and stays just around 69.70, 72, 73, and the implied volatility of my call drops back down to say 0.25 or 0.3, I'm fine. It's going to be cheaper to buy back. But I need to know this. This is the one, the farther out option, where the pricing model is being applied to that position. And the potential outcome of what this would look like on November expiration, if the stock's trading at any of these prices or trading at the same price, can fluctuate drastically if this goes back to the low value or goes back to the average. And to see that, once I've entered a position into the custom spread, or I've linked to the profit and loss chart and added my call here to see the new dynamic from the married put search, I'll click the little blue button next to the put. We'll go to research and we'll go to option research. We saw we went to the stock research tool to check the earnings. We're going to go to the option research tool now as well. Now, the option research tool is kind of neat because it gives me the history since this option was released in the market of implied volatility versus option bid price as a default. So this option was actually released on August 20th, 2023 for April 2024 expiration. I can compare against different metrics though on this historical graph. I can look at option last price versus option bid or vice versa. But yeah, we can look at the percent if assigned, the stock price, option volume, bid ask, open interest, time value, delta, or delta versus time value or so forth. You can look at the different charts here. The default here is because this is normally what we look at. Some would want to look at maybe the option time value versus the stock price, or time value versus implied volatility. I tend to just look at the option bid versus implied volatility. That being said, this shows us all of the available data that we have for this particular option, including calculating the percent return if assigned or not assigned, downside protection, naked if this was traded as a covered call. So remember, we're looking at a short call position. Or the naked yield if we sold that, the time value of the bid, time value of the ask as a monetary value and a percentage. You've got your Greeks here, of course, too, but you can also see that on the search tool. And then we have the implied volatility range. Since this option has been released, the implied volatility has fluctuated between 0.4232 to 0.5604. We saw currently it's at 0.51502, so we're at the 67% range for this total option since it's been released on the market. So there's that low point there, September 8th at the 0.42, 0.43 level. And the high point, of course, we peaked out at 0.54, 0.56. There it is, somewhere up here. And then right now we're at that 0.5155. Why is that important? Let's say that I feel the stock's going to move up close to my short call strike price. We're looking at the 75. Let's say that we feel it's going to gap up to 74 on or around our earnings of 11.2. We've got protection in place, and we hit calculate. Well, using those values, it's showing me a small profit of $134. That doesn't seem right here. Oh, because we still have a long way to go to expiration. That's about right. Yeah, 11.2, but looking at a profit about 138, 74.45. Yeah, so we're right in that wheelhouse there range that we're looking at. Let's go to November expiration to see a little bit better. So it goes after the earnings on November 2, pops up, rides out, stays at the 74 level to November expiration. Okay, so we keep the full 150 on the call. Our put is still valued at 946. We only lost 299. We've gained 542 on the stock, so we've got a total profit of 393. Right, that's what we expect right there. And that's 1117, yeah. So right about in that level of 390, 394, 400 or so. That's a 74.45. Okay. But the total IV range was from 0.4232 to 0.564. I'm in the upper echelon, 67% of that total IV range. I need to be prepared if what does happen after earnings on the 2nd, and it does move up to that 72, 73 range, then continues up. But what happens if this goes back to the regular low implied volatility of, say, 0.43? If the stock's trading at 74 on the expiration date. Now here we show we only lost about $300 from 1245 to 946 theoretically. That change from 0.51 down to 0.43 almost not quite doubles the loss, but it's a 50% higher. We're at 460. So now the profit's only $232. And if it reverts back down to 42, it'll be about the same, probably 470, 460 if the stock's trading at 74. So I want to be prepared for that, because although the graph is showing me what's possible, anytime you're in a calendar call, calendar put, double diagonal, comparing different expirations. The graph that you're seeing, remember, is based on what all options involved in that trade would be worth if the stock was trading at X prices on the nearest expiration date. You've got 4 or 5 legs in here, maybe laddering a covered call for, say, next week out on the 3rd, the 10th, the 17th, and November 24th. And you're looking at the graph and you say, okay, well, as long as it's trading at these prices at any time, I'm going to make this profit. No, it's looking at it based on the nearest term expiration, November 3rd. And if you've got a mix of buys and calls and the buys are further out in time, you want to make sure that you take a look again at that option research tool for those bought options that are further out or different expiration, the buy options. That's what it mostly affects. Check the total IV range by linking to that option research tool, and then put in the lower end values to see how that might potentially affect your trade if the implied volatility shifts on those options and goes back to the norm after an earnings event or something along those lines. So it's always important for those kind of strategies, especially some investors I know who've called in and asked questions at coaching sessions and so forth about doing the calendar spreads, different types of calendar spreads on or around earnings events. What am I looking for? And if I try to sell a call before the earnings event and buy a call afterwards, hoping for a big spike or movement in the stock, well, you also have to pay attention to the implied volatility crush, because that option that you bought is going to be most affected by a change in implied volatility. Or if you're doing both, you're selling the near-term option a day or two in that same week expiration after the earnings because you like the inflated premium, and you're buying something further out and it doesn't have as high as a volatility, but that implied volatility on that farther out option will still be inflated. You need to make sure that you check and evaluate the graphical interpretation of that position if the implied volatility drops back to the norm, because that could greatly affect expected profits on the position, as it won't be as high as you originally expected due to the IV flux.